Bloomberg Audio Studios. Podcasts, radio, news.
We continue to expect another slight increase in the unemployment rate to 4.7% in December. Veronica joins us now. Veronica, thank you so much for being here.
Thanks for having me.
Happy holidays.
Happy
I'm just
holidays.
wondering from your perspective how much the data that we got earlier this month was actually valid and that people are discounting it too much.
Yeah, I think there's a lot of that going on. And if we saw the unemployment rate next Friday, the first week back to work, if we saw that at something like 4.7, I think people will believe it a lot more because, there's a lot of issues with the November, October data. We don't know how much the government shutdown affected the measurement of those months. But December should be relatively clean. And if it stays pretty high, I think that's a more concerning sign for people.
How come this labor market is weak? I don't get it because you've got incredible earnings growth, right? So corporate America is doing very well, and there are no new people coming into this country, right? There's no immigration. The demographics trend, like everyone's old. There are no young people. Like it should be companies are fighting for employees.
Yeah. I mean, there's been this, issue of, is it labor supply? Is it labor demand? We've been dealing with this for a couple years now. Back in 2024, when we saw the unemployment rate increase, the excuse was also it's more immigration. I don't think we can use immigration to explain the bad data, different sides of immigration to explain bad data. But I think what's happened is that labor demand has just weakened more than labor supply, and that's why you've seen the unemployment rate rising. It's this low hiring, still low firing dynamic, but I would be worried that low hiring can only last for so long before maybe you do see some layoffs.
So is that because technology and AI have made the few employees that companies hold on to more productive?
I'm a little hesitant to conclude that that's what's happening now. That might be part of the story, absolutely, and we could see larger productivity gains from AI longer run. But this really started a couple years ago. This really started maybe summer of 2023 when we saw this pullback in hiring. And I do worry that it started in more rate-sensitive sectors like manufacturing, small businesses. The pullback has really been there, and so it doesn't necessarily matter if equities are doing well and earnings are fine. Small businesses are going to be more rate sensitive.
Aren't we bringing manufacturing back? I thought we were bringing manufacturing back, right?
We have been losing manufacturing jobs, I think, every month this year. But that predates this year also, and it is a rate sensitive sector.
Well, this sort of speaks to the question of, is the Fed restrictive? And this is the big debate. Restrictive for who? Because on one hand, you do see companies filing for bankruptcy at the fastest clip going back to 2020. On the flip side, you see AI companies screaming ahead, Digital Bridge being purchased for $4 billion at a 15% premium. So can you square that?
Yeah, I mean, there's this bifurcation across all parts of the economy. I think there's a lot that has already been said about the K-shaped economy for consumers. Higher income consumers are spending, but we definitely see that in sectors also. And the smaller businesses who are more rate sensitive, I think rates are restrictive here.
So you expect a significant number of rate cuts. Let's just postulate that we do see an increase further in the unemployment rate to 4.7% as you expect. What does that mean for January 28th?
Yeah, I think they're going to be cutting.
Really?
Yeah, so we are penciling in another cut in January, another one in March. And it's just this kind of idea that you've clearly gotten more concerned on the labor market side of your mandate if the unemployment rate is something like 4.7 that we think we'll see in December. We will have hopefully more inflation data by March that we trust again, early 2026 data. If you're seeing inflation slowing and data that you believe again, and you're less concerned on the inflation side of the mandate, you're more concerned on employment, why wouldn't you be at the midpoint of neutral, which would be cuts in January and March to get you there?
The counter argument is if you get rate cuts, potentially 2 by the end of March, at the same time that you have the one big beautiful bill, the tax refunds, and potentially an additional $2,000 stimulus or whatever else might be coming down the pike, don't you risk reigniting inflation that never died?
Yeah, I'm not so concerned about that right now. The inflation driven by lower rates, more stimulative monetary policy, you would expect to see it first in a sector like housing, and you definitely don't see that yet. You don't see those signs yet. Home prices have been slowing. New rents have been slowing a lot. We already know that in the inflation data, there's this lag issue of shelter inflation. That's going to, I think, be slowing all of next year. All of the potential fiscal stimulus, maybe larger tax refunds, the business tax incentives that were part of the bill from the summer, those can help support growth. But I would worry that the main determinant of if people are spending or not is if they have a job and what their labor income is. is. And that we have seen slowing already. And you would think consumption would slow then too.
Veronica Clark, thank you so much for being here and for holding down the fort for the economics team at Citigroup. Veronica Clark of Citigroup Global Markets.